Hey everybody, Smart Silver Stacker here. Hope you're doing well. You know, we talk a lot about the price of gold and silver on this channel, and with good reason. Both metals have been on a real rip thus far in 2024, with gold up over 13% year to date and silver up a remarkable 27.5%. And you know my take. Both gold and silver are money, they are trusted safe haven assets, and they don't have the counterparty risk that comes along with today's over-leveraged digital global financial system. But for the resource-minded investor, there are other assets that will perform well during the coming period of high inflation and explosive growth in high-tech industry. Other commodities, aside from just the traditional precious metals, are worth taking a look at. Although, of course, gold and silver, they're going to come along for the ride in this commodity bull market as well. And today I want to touch on a few of those other resources, the factors that will be driving their prices to new highs, and why huge amounts of these resources will be consumed in the years ahead. A great example of the trend that I am describing is copper. The price of copper has risen 22.6% so far in 2024, and it recently touched an all-time record high of $5.11 per pound. They call copper Dr. Copper for its usefulness in diagnosing the overall health of the economy. And right now, the prognosis is for higher inflation and higher commodity prices moving forward. Copper, like silver, is a critical industrial metal with a whole host of applications, but perhaps most importantly is its role in power generation and transmission. Copper wire is what you need to transmit electricity, and power demand and consumption in the US and abroad is about to skyrocket. The nascent AI revolution all but guarantees it. One thing we don't hear much about AI is just how energy intensive artificial intelligence really is. Consider this. The average ChatGPT search consumes about 10 times the electricity of a traditional Google search. So if Google, for example, wants to incorporate AI into all of its searches, this could increase its power needs by a factor of 10. And it's easy to see just how much electrical generation capacity and transmission infrastructure will be needed to bring the next level of artificial intelligence and computational power online. The International Energy Agency forecasts that by 2026, power consumed by AI data centers and cryptocurrency will have nearly doubled from 2022 levels. Huge amounts of raw materials will be needed to build the infrastructure necessary to feed this level of power demand. Given the fact that many of the players in big tech have committed themselves to carbon neutral or even zero carbon goals, much of that power generation is going to be coming from alternative energy sources such as solar. That much solar is going to need a lot of copper, a lot of silver, as well as other scarce physical commodities. As if the AI revolution and the huge energy demand it will create isn't enough, don't forget that developing economies around the world are also consuming vast quantities of energy as they catch up to the West. This is reflected in part in how the globe is massively increasing solar capacity right now. Consider this. Solar installations in India totaled 10 gigawatts in the first quarter of 2024. That is a record quarter for them, and it's up greater than 400% from the amount of solar installations India performed in quarter 4 of 2023. And while that is a significant acceleration, solar capacity expansion in India pales in comparison to what is happening in China. And I want to give you some numbers to put all of this into context for you. In the US, total solar capacity at the end of 2023 was 179 gigawatts. Okay, so India installed 10 gigawatts in Q1 2024. Pretty impressive, right? Well, China in 2023 installed 216.9 gigawatts of solar capacity. That's more than the US has built in its entire history. And this number represents a massive increase from the 87 gigawatts China installed in 2022. It's no wonder that silver, a critical component in photovoltaic systems, experienced a greater than 100 million ounce deficit last year due to rising industrial demand. And it appears to me that new records in the copper price are just the beginning when you examine our current trajectory. And for copper, a quick aside, if you want to get your hands on some physical bullion, I would actually stay away from bars and rounds of pure copper like this one. They usually come with a significant premium over the spot price, and there are really much better options. For example, a real copper penny, the kind minted before they switched the alloy to zinc in 1982. Each one of these pennies contains over 3 cents worth of metal. So this is one form of copper bullion you can still find in circulation, although Gresham's law will diminish the supply over time. US nickel coins, which are 75% copper and 25% nickel, now also contain more than 6 cents of physical metal, following the recent commodity breakout. If you think about it this way, you can buy a roll of nickels like this for $2 at any bank, and you're getting about $2.40 worth of nickel and copper bullion for that price. Now, sure, these coins, they do take up a lot of space. They're heavy. Stacking base metals is not for everyone, but also getting physical metal below spot price, that's always nice. And, I mentioned that the silver market has been in a physical deficit with more metal being consumed than is being produced by mining and recycling. But it's not the only commodity that falls into this category. Platinum is another example of a critical industrial commodity in short supply. Platinum is an important catalyst in the chemical industry. It's a critical component of fuel cells, and it's also used extensively in catalytic converters for automobiles. And while the political elites around the world would probably like to force everyone to buy electric vehicles, it's looking to me like internal combustion engines, they're still going to be around for a while. Now, according to the World Platinum Investment Council, platinum is on track for a deficit of 418,000 troy ounces in 2024. That's an improvement from last year's deficit of 878,000 troy ounces, but still it is indicative of a major disconnect between production and demand. Over the past decade, we've already seen huge price spikes in other platinum group metals like rhodium and palladium, and we may well be on track for a similar move in the price of platinum. We've even seen the price of food commodities such as coffee spiking this year, as extreme weather and unsustainable agricultural practices have led to supply disruptions. The price of cocoa recently skyrocketed in a parabolic run to new all-time highs. Fundamentally, there are a variety of factors contributing to higher prices for all of these commodities, but one factor that these price hikes have in common is the debasement of the currency in which they are being priced. According to official numbers, U.S. aggregate inflation since January 2020 is over 25%, and yet fiscal policy remains incredibly inflationary. U.S. deficits have exceeded $2 trillion annually. The national debt now sits at a whopping $34.7 trillion, and the interest alone is now the third largest item on the federal budget at over $1 trillion per year. So the inflation is not going to stop, and the rising prices of commodities that we are witnessing is really only the beginning. One commodity worth taking a look at in the current environment, but that doesn't get much attention, is tin. Tin, much like silver and copper, is a critical material for high-tech industry. It is literally the glue that holds electronics components together in the form of solder. Over 50% of the world's tin is used as solder in applications ranging from solar energy, electric and traditional internal combustion vehicles, Internet of Things devices, 5G, semiconductors, you name it. Anywhere electronics are connected to circuit boards, you need tin. This broad range of applications means that the world is going to need a lot more tin. In fact, Rio Tinto Mining and MIT completed a study showing that tin was the metal most impacted by new technology. In the first quarter of 2024, tin was the best performing base metal, and the price is beginning to reflect increasing demand. Here's what resource investing legend Rick Rule recently had to say about tin in an interview on the In It to Win It YouTube channel.
Tin is the forgotten energy transition material. I mean, the tin price has done well in the last 2 years. I think tin continues to do well. To the extent that there's ever any need to solder anything, tin will do well. It's the best substance in the world. Tin production is fairly constrained, too.
And he's right. Production is somewhat constrained. China is the world's biggest tin producer, but their industry consumes more than they produce. Other major producers include Russia and Brazil, members of the BRICS organization, increasingly at odds with the US. Indonesia is currently the world's leading exporter of tin. However, exports have been plummeting following delays in government-approved work permits. highlighting the unreliability of this source of supply. Production in African nations such as Nigeria and Rwanda comes with its own significant jurisdictional risks, and this is important to consider from an investment standpoint. For investors seeking to gain exposure to tin produced in a safe, secure jurisdiction, choices are limited. There's no tin ETF, so a pure play in tin is even tougher to come by. And that's where today's video sponsor, IBER can add significant value for investors. To really dive into why, we need to clear something up first. Currently, IBER is known as IBER Lithium, but this company recently announced that it is changing its name to IBER Resources and is pivoting its business model by acquiring one of Europe's biggest tin mines, a property in northwest Spain known as the Penota Project. The current owner of the Penota Project has run into severe operational issues and had to shut down production last October. But before production was halted, this site was hitting historic production numbers. IBER CEO Campbell Becker plans to resume operations at the Penota Project and increase revenues by improving quality, adding efficiency, and boosting production levels. Pending shareholder approval and financing to fund the restart and continued operation of this mine, the change in ownership should take place in the matter of a few short weeks, resulting in a company with a market capitalization of around $22 million. The previous owner's valuation during production at this site peaked at $78 million. So IBER represents the opportunity to get a huge discount on this asset. The purchase price of this mine will actually be the bargain basement price of only 6 million Canadian dollars, an incredible discount considering that the previous owner had accrued tens of millions of dollars in expenses improving and developing this site. This is a scenario in which IBER is acquiring an incredibly distressed and undervalued asset in the resource space, just as we enter into a major bull market in commodities. And yes, this one is a speculative play. There are moving parts that need to come together here, but the potential is significant. And as an added benefit, IBER provides diversification for the commodity investor into a metal that few other companies focus on. A pure tin play in a secure jurisdiction is fairly unique, and for that reason alone, this company is worth examining further. Of course, don't buy this stock just because you heard about it here. As always, make sure you do your own due diligence. IBER trades in the US under ticker symbol IBRLF. And remember, gold and silver will likely boom in the coming bull market, but diversifying into other commodities may pay off as well. So check this one out. And let me know what you think in the comments down below. Stay safe and happy stacking, everyone. Smart Silver Stacker, out.